All right, Friday's big January jobs report makes it seem like the economy is booming, and stock index levels back that up. But GDP growth numbers are coming down, and the bond market is trading as if there is weakness ahead. Steve Liesman joins us now with the real story. Morning, Steve.
Morning, Mike. Concern about the coronavirus weighing heavily on the outlook for first quarter growth. And some forecasters think the equity market is not taking the threat as seriously as the bond market. A CNBC survey over the weekend finds first quarter GDP forecasts averaging just 1.2%, down nearly a point from the fourth quarter, and with just a modest bounce back to 1.9 in the second quarter. The forecast range from a low of 0.4 from UBS to a high of 2% for Action Economics. The downgrade comes importantly as the U.S. data has improved somewhat, especially the business survey data with the conclusion of the U.S.-China trade deal and a blockbuster January jobs report. It's the result mostly of a downgrade to Chinese growth along with the shutdown of production of the Boeing 737 MAX. Bonds seem far more concerned about all this than stocks. The 10-year yield off almost 33 basis points since the beginning of the year, but the S&P remains up almost 90 points. J.P. Morgan writing over the weekend, rate markets are sending warning signs, creating renewed disconnect between rate and equity markets. What we find complacent is the idea among some market participants that Chinese economic weakness will have limited repercussions for the rest of the world. The downdraft in bond yields comes with a belief that the Fed will act by the summer and again possibly in January 2021. That might be propping up the equity markets. We'll hear from Fed Chairman Jay Powell just how realistic that outlook is. And I can see how it's hard not to buy equities with the strong jobs market we had and all the other strong data we've had. But you look at how the bond market's trading and you think like
I'm not buying it. You know
what are you not buying? Which part?
No, I'm telling you. I just think that bond market investors just are generally really Debbie Downers almost all the time. They're willing to accept really scary things immediately, and they get out of the way long before other people do.
But isn't the general idea that the bond market is smarter than the equity market?
I don't know.
We've been talking about that for
really,
a long time.
how many yield curves have not resulted in recessions? Like it's like 3 out of 12.
I can't remember. Something like that. Yeah, 5 out of 9.
They're
or
way
something.
too.
But same thing with 20% downdrafts in stocks. Yeah. When everybody thinks the bear market, that the equity market has perfect pressures.
If you were a bond and you thought there was a possibility of something like 1918, you would immediately go, the yield would go to zero. You think growth is going to go to zero.
Right.
And how many times do these pandemics become pandemics? They usually don't. And in the middle of it,
there's only been one.
In the middle of it, we're really scared. I remember bird flu. I remember SARS. I remember, what was the other one? There was a swine flu.
Joe, let me just posit a middle ground here. I know we have two terrific guests we want to get to in a second, but the idea that was in that J.P. Morgan quote there, that there is this knock-on effect from the shutdown of the industrial heartland of China, that the stock market is not taking as seriously as the bond market. That doesn't suggest apocalypse, but it suggests there is some downdraft coming to either growth and or earnings that have not yet been priced in.